How much time you dedicate to your investments can help determine which strategies are better suited for you. Most investing strategies can be generally categorized as either active or passive. Active investing is considered a hands on approach, and the strategy can be used by an individual investor or a fund manager. In this lesson, we'll use the example of an individual investor when talking about an active investing strategy. An investor who opts for an active strategy may research the markets and invest products by themselves. They frequently decide what investment products to buy and sell, and they also may check in on the performance of their investments more frequently. Passive investing, on the other hand, is considered a more hands-off approach. An investor using a passive strategy may be limited in their research. They may not trade as often, and the products they invest in are typically ones that are, you guessed it, passively managed. This could be an ETF, exchange traded fund, or mutual fund that mirrors a benchmark or index. What's an index? An index is a way to measure the performance of a group of assets in a way that's easy to understand. Some of the more popular stock indices in North America are the Dow Jones Industrial Average, the S&P 500, the Nasdaq Composite, and the TSX Composite. An example of a passive investing strategy is index investing. An investor using this strategy typically invests in ETFs and mutual funds that mirror an index, like the ones we just mentioned. However, there are other indices, like those that track bonds or foreign stocks. Because index funds are designed to track a certain index, they are passively managed and have relatively lower expenses when compared to other funds. Let's take what we've learned about passive and active investing and compare the two strategies side by side. First, let's look at the goal of each strategy. The goal of an active investing strategy is to outperform the market or some other benchmark. But with a passive investing strategy, the goal is to mirror or track the market or some other benchmark. Active investing strategies can be used in any investment timeframe. However, passive investing strategies are typically used when the time frame is 5 years or more. When we talk about costs, we're referring to the commissions paid for a trade or the fees a fund manager might receive. These fees are typically displayed as a percentage called the management expense ratio, or MER. The lower the number, the better for the investor. In almost every case, costs are typically higher for an active investing strategy. This can be due to a higher MER on actively managed products, more commissionable trades for individual securities, or both. Since passive investing strategies generally involve ETFs or mutual funds, the investor may be provided with more diversification when compared to an active investing strategy that focuses on selecting individual stocks. That said, an active investing strategy can also use actively managed products like ETFs or mutual funds instead of individual stocks, which can help provide greater diversification. Remember the lists of activities an active investor might do? Researching the markets, researching individual investment products, and determining what and when to buy and sell. As you can imagine, managing an active investing strategy will require more of a time commitment. Ultimately, there is no right or wrong answer when deciding between the two strategies. The decision really depends on your goals and personal situation. And in some cases, using a mix of both passive and active strategies may make sense as well.